I think we'll probably do is create boom bust cycles. Again, you can't have the bust cycle going below the level of central bank liquidity because optically they make it rise. This is what people don't yet understand. But of course, the stock market should go down 90%. Can't happen. Literally can't happen because of the debasement. It's a money illusion. But what I think we'll do is see, hey, off we go to the races. That's what happened in 2018. 19, early 20, we actually diverged from the central bank balance sheet massively because people starting to figure out this game, which is the moment the Fed stop the tightening cycle, markets take off.
Raoul Pal, the founder of Real Vision and an expert in macroeconomics and cryptocurrency, discusses how liquidity, business cycles, and central bank actions shape economic trends and asset prices. He notes that liquidity, or the economy's money flow, is vital for influencing financial markets. Business cycles, which show the regular ups and downs of economic activity, are influenced by factors like interest rates and inventory levels, and have been consistent throughout history. Pal argues that markets would naturally adjust interest rates based on economic conditions, even without central banks. However, central banks often intervene, which can distort these cycles and lead to significant boom and bust periods. For example, raising interest rates can slow economic activity, while lowering them can spark speculative growth, creating a pattern of rapid increases followed by sharp declines in asset prices. According to Pal, the balance sheets of central banks, particularly the Federal Reserve, are crucial indicators of future market trends. As these institutions expand their balance sheets to manage debt and stimulate economies, asset prices tend to rise dramatically, especially in sectors like equities and cryptocurrencies. Pal points out that the Fed's balance sheet, currently around $6.5 trillion, could swell to as much as $12 to $14 trillion by 2025. This projected expansion will fuel market rallies, reinforcing a pattern where liquidity injections translate into higher valuations across various asset classes. However, he warns that these gains may mask the long-term effects of currency debasement, creating what he describes as a money illusion, where nominal asset prices increase, but the purchasing power of currencies erodes. Raoul Pal anticipates that cryptocurrencies will be the main beneficiaries of ongoing central bank liquidity injections, predicting a significant crypto rally that could peak around 2025. He refers to digital assets as the best performing assets of all time, and stresses adapting to these changing dynamics. Pal's message is straightforward. The upcoming years present a unique chance to leverage these trends, and those who understand the importance of liquidity and strategically position themselves will be better equipped to succeed in the evolving economic landscape. Now let's watch the clips from Raoul Pal's interview. Before we proceed, please take a moment to like this video, subscribe to the channel, and hit the notification bell so you don't miss any future updates.
I know what drives liquidity. It's driven by the business cycle. And there are certain cycles that are forward-looking. The Chinese credit cycle happens to lead by about 18 months or 2 years.
For people that don't know what the business cycle is, can you give a quick primer?
The business cycle is the ebb and flow in economic activity that occurs, and that's a boom and bust, a recession expansion.
Is it caused by interest rates?
We don't really know what causes the business cycle. It's caused partly by interest rates. It's caused by excess production, excess inventories, too limited inventories. There's many things that can drive a business cycle, but it's observable and has been observable for millennia. And one of the things we do is when the business cycle is too hot and inflation starts rising, central banks tend to raise interest rates. That tends to bring down economic activity. I think even without a central bank, interest rates would rise naturally. Because I think the free market can set interest rates without a central bank. And then the economy slows down again, and we see this endless cycle. So what I think my hypothesis is that, okay, this is very observable. I think it's going to last, this relationship between assets and the central bank balance sheet because of the mechanism of debasement of currency. And I can forecast out what the business cycle looks like. And I also know the amount of interest payments that need to be made because they happened 3.5 years ago. And I can see how far the balance sheet's going to expand. So the balance sheet right now is what, $6.5 trillion. And it looks like it will get $7 trillion or so. And it looks like it will get to $12 to $14 trillion by the end of 2025. So that puts, and there's a number of other ways I've proven this out in this whole thing, and I'll send you the whole piece myself, because I've not really gone public with all of the whole thing of how it works. But in the end, that puts asset prices massively higher than here, hugely higher. So we're looking at more than a doubling of the NASDAQ from here. We're looking at another gigantic crypto run. That's into 2025. So we're seeing huge moves that just come from the debasement. And I've gone through in the Everything Code article that I wrote for Global Macro Investor, which is my kind of premium research service. In that, I've gone through various ways of proving this all out. So that's what I think I can do. But your observation, I think, is really important. Okay, when people, I mean, I've sent this to quite a few people, and obviously the subscribers of Global Macro Investor are kind of the world's most famous hedge fund managers, asset managers. And I think it really shocked people and resonated with people. They're like, oh my God, everything makes sense now. And so once you see it, it all makes sense. Now, as it becomes more public as a thesis, and Mike Howell at Cross Border Capital has been talking some elements of this, liquidity, you can see liquidity becoming part of the conversation on financial Twitter and stuff now. What I think we'll probably do is create boom bust cycles. Again, you can't have the bust cycle going below the level of central bank liquidity because optically they make it rise. This is what people don't yet understand. But of course, the stock market should go down 90%. Can't happen. Literally can't happen because of the debasement. It's a money illusion. But what I think we'll do is see, hey, off we go to the races. That's what happened in 2018. 19, early 20, we actually diverged from the central bank balance sheet massively, because people starting to figure out this game, which is the moment the Fed stop the tightening cycle, markets take off, because they know that the probability of more cowbell, more central bank printing of money, more interest rate cuts is coming. And so therefore we get boom bust cycles. So the boom times are too big, and then you get a bust. And people know that from crypto as well. The long-term trend remains intact, but we keep getting these huge booms, collapse, boom, collapse, but the trend is still up. I think that's what we'll see. We'll be more like the crypto cycle, which is pretty much what we've just seen as well. We had a big collapse last year, and now we're straight back into the boom as we're starting to forecast this.
Recent headlines spotlight the escalating difficulties confronting our global financial system, with central banks racing to tackle inflation and economic instability. Raoul Pal, founder of Real Vision, offers a forthright analysis of the current predicament within this landscape. He contends that since the 2008 financial crisis, we've largely been printing money out of thin air to sustain economic activity. According to Pal, this approach has transformed the bankruptcy of the financial system into a shared burden, impacting everyone rather than just those at the top. Raoul Pal highlights that quantitative easing dilutes currency value, leading to the illusion that asset prices are rising. However, when examining the S&P 500 and real estate against central bank balance sheets, these assets haven't truly increased in value. He notes a significant disconnect between rising stock prices and stagnant wages, making homeownership increasingly difficult for younger generations as the market grows more expensive. Despite the appearance of wealth due to inflated asset prices, most people aren't genuinely getting richer, resulting in widespread frustration. Pal warns that while this currency debasement may stave off a major banking crisis, like the one in 2008, it carries significant economic risks.
What we are doing since 2008 is mutualizing the bankruptcy of the system via the debasement of currency, which is the...
When you say mutualizing, you mean making it everybody's problem?
Yes. You can either raise taxes, which they're trying to do too, but they're also printing currency via the mechanism called quantitative easing, which is actually debasing the currency, which means that every time they do it, asset prices optically rise. They don't actually rise. Because if you look at the central bank balance sheet and divide all assets by it, so you're changing the denominator, it's normally US dollars, but when you use the balance sheet, you say, okay, this is the purchasing power of dollars. Now, how many dollars are in the economy or excess printed? And what you find is something like the S&P 500 has gone nowhere. Real estate, gold, gone nowhere. And there's only two assets that have actually outperformed, which were crypto and technology. Okay, which is why we all feel like even though stocks are going up and our 401k is going up, nobody's getting any richer. Okay, we all know this intuitively, that we're not actually getting richer because the stocks I sell doesn't buy me more of a house. So what was the point of buying the stocks if the value of my assets aren't going up? But that is a mutualization, which is bad because it mutualizes it amongst people who don't have assets. So you'll never be able to buy an asset, which is why when you speak to a millennial now, they're like, we can't afford a house. Why? Because they came in to the labor force after the Fed started monetizing or lowering the value of the denominator. So property's got more and more expensive for them. It's impossible for them to buy property really, unless they're really lucky in the workforce or in entrepreneurship or whatever it is. But generally speaking, it's become impossible. And everything has got more and more expensive, assets have, because of this optical illusion. But wages haven't gone up, remember, right? That's the key thing. Assets are going like this. We were doing this before because of demographics, and it was making people pissed. And now we're doing it from debasement, and there's no way around it. So what debasement does, on the other hand, remember, it makes the price of assets look like it's going up. This is why you can't have a banking crisis of the order of magnitude that existed before 2008. The reason being is you just print money the moment you see it, and voila, everything goes up. So the value of your collateral, so if you think about a debt, it's collateral plus the debt, and the collateral is what guarantees the debt. If you've got a banking crisis, your collateral is often falling so fast that, like commercial real estate, right? We're going to have a problem with that. So there's a bunch of debt, and the banks have got this commercial real estate as collateral, and it's all bloody empty, and everybody's going to try and get out of it. So the answer to that is print money and essentially magic that collateral higher, or put it on the central bank balance sheet. Europe has already done this. So I don't think you can have a systemic collapse because the value of the assets can never go down enough. This is what most people can't get their heads around.
Well, so I'm going to...
But we will get, slightly... but we'll play out the future a bit, because there are ways where it could go even more wrong than this ongoing mutualization amongst the people of the costs.
It can go even more wrong.
Well, this is wrong because it's insidious. You don't see it, you don't notice it, you just sense it, right? That's what's going on. But it could lead to another outcome. And the other outcome could be a total loss of control of the financial system. I don't think that is going to be the case. But okay, there's a possibility.
With rising inflation and economic uncertainty challenging global financial systems, cryptocurrencies are poised for a bright future. The ongoing reliance on quantitative easing is leading more people to seek refuge in digital assets, anticipating significant gains as the market rallies around 2025. This shift highlights the potential for cryptocurrencies to reshape wealth and investment, offering a decentralized alternative in an increasingly unstable financial landscape. Share your thoughts in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time!